simple question from CA final on bond refunding. I found this question really interesting and the concept really interesting, but there are a few flaws in the way ICI solves it. So first, let's read the question. The question is from PADHUKA, question number 19, and I think it was in CA final November 2018, and in the RTPs and MTPs as well somewhere in the recent SFM papers, not the AFM. However, let's begin. The first thing the question states is that there is a company, Trans India Limited, that is contemplating to calling its 3 crore rupee of 30 years rupee 1000 bonds issued 5 years ago with a coupon interest rate of 14%. So there is a lot of information. So what I like to do is write it down. They're trying to call 3 crore rupees of floating of fair value face value of 1000, and which were issued 5 years ago, but it has an original term of 30 years. So left term is just 25 years and a coupon interest of 14%. All right. The second statement. So first statement is now useless. We have read it. We can mark it as gray. The bonds have a call price of 1140 and had initially collected proceeds of 2.91 crores due to a discount of 30 per bond. Okay, so now we write down the call price first, and the second thing is they get proceeds of 2.91. That's irrelevant for me, but what you want is the discount. If there is a discount, you need to know it, and the same has been calculated based on 30 per bond. So each bond is of 1000 value. 3 crore rupees of bonds were issued, so 3 crore divided by 1000 times 30 gives you 9 lakh of the discount. That's obviously evident from 3 crores minus the 2.91 as well. Right, so the second statement is again useless now. The third statement is initial floating cost was 3 lakh 60,000. We write it down, and this is also useless now. The company intends to sell 3 crore bonds of 12% coupon rate 25-year bonds to raise funds for retiring old bonds. Okay, the company intends to sell 3 crore of 12% coupon rate. So we write it down. They want to sell, that means they want to go for a new issue of 3 crores, coupon rate 12%, term of 25 years. And I think the par value is also 1,000, and the estimated floating cost are 4 lakh rupees. And this is all about the new issue. I think that's again done. The company is paying 40% tax rate, and its after tax cost of debt is 8%. So this is what you need to take into account while discounting. So the tax rate is 40%, the post tax cost of debt is 8%, and pre-tax cost of debt would be dividing 8 by 60%, that gives you 13.3. So that's just the formula in there, nothing too strange. Okay, now they they add just a simple line that twists the answer a bit. As the new bonds first must be sold, and then their proceeds should be used to retire the old bonds. The company expects a 2-month period of overlapping interest. So an overlapping interest period of 2 months. So you would be paying additional interest of 14. What I would not like to call overlapping here, uh, not overlapping, but additional interest of 14% on the bonds not yet redeemed. Okay, this is how I like to think about it, rather to think about it as an overlapping interest, because in that sense maybe you will add back the 12% of the new coupon rate as well. Okay, and now they want us to really talk about what is the feasibility of refunding the bond. So first we have written down all the data points from the question, and now we try to go for first. The first step is making an amortization table. What is an amortization table? Because the bonds will have some cost, whether it's the issue cost or it is the discount on issue. Both are costs which need to be amortized over the bond or the bond's term period. So we are looking at the old bond and the new bond. The old bond had the issue cost, which is again just 3,60,000. You can link it, but in C exams there are no linkings, so you just have to write it down sometimes. And there is a discount of 9 lakhs, but there is no discount here. All right. And then you get the total cost to be amortized. Okay. The amortization period is, of course, based on the term. So it was 30 for the old bonds, and for the new bonds, it would be 25 because new bonds are just for the 25 years. So amortization per year, per period would be just the total amortization cost divided by the number of years. Now, what we get is the post-tax benefit. So you get a tax deduction by you know giving these cost into your tax returns. So you get a tax deduction of the effective rate of 40%. So the net cost would be just 42,000 times 60%, and for 16,000 times 16%. So you have just incrementally saved 15,600 and not the total amount. Okay. And so today we have what unamortized cost is left today would be 42,000 times 25, which means that today we have an amortized cost sitting on the asset side of the balance sheet that needs to be flushed once these old bonds are redeemed. Okay, so 10 lakh 50,000 would be the unamortized cost today, and what when once these bonds are redeemed, you will be able to expense these out in your profit and loss and avail the tax benefit immediately instead of the amortization over the 25 years. So you get an immediate tax benefit of 4,20,000 at Y0. So this is a tax benefit while you have lost savings for the next 25 years on your tax deductions. So what was the tax deduction you were getting on 26,000? That is the incremental saving that you have made. You save 26,000 saved cost, and you loss you have lost a deduction, lost deduction. Okay. So for some reason ICI discounts this at the 8%, that is the post tax rate, which is, I think, it's a bit foolish, because when you're discounting a post tax benefit, you have to use the pre tax rate. And if you're using the post tax rate, then it is not really a post tax benefit. And it links back to the uh, AVP analysis, that is the adjusted present value analysis, where you always discount the financing benefits at the pre-tax cost of debt. So however, ICI discounts at 8%. So here is the fallacy. So discount at 8% instead of 13.3%. Conceptual mistake by ICI. Okay, so this is one thing to remember in this scenario. Now, assuming that these costs are written off today, as the bonds are redeemed, we will avail the tax benefit today. So this is the first part of the question, that you try to calculate the benefits from the immediate writing off of the cost and the loss savings from the annuity of the tax deductions. And for annuity, I have used the PV formula in Excel. However, this would be provided in the exam as something like what would be it? It would be given as the PVAF of what 8% for 25 years at a payment of 1 is given as 10.67. So it will give you something like PVAF of 8% comma 16 is this. This is what they will tell you in the exam. All right. But use that figure instead of calculating on the calculator, wasting time. Let's go to the step 2. Step 2 is looking at the interest cost saved. So there is certainly, you can see the coupon rate has decreased from 14% to 12%. So obviously the new bond are at cheaper rate of interest, and we need to calculate the benefit out of it. So the current coupon rates are given. The interest per annum would be calculated based on the 3 crores of the 3 crore rupees of outstanding bond issue. And then you have the post tax benefit. I don't know why do they do this, because the discounting rate again used is post tax 8%, and therefore the fallacy again here remains the same, that we are discounting at that we are again discounting at the post-tax rate instead of the pre-tax rate, which is not the right way of really doing this thing. If we look at it conceptually from the point of view, this is similar to an AVP analysis when there is change in the capital structure. So that's what I look at it conceptually. And so you see there are net savings of cost, which is net of the tax reduction, and then you discount it by the post tax rate for some reason, and then you get the present value of the savings. All right. Now we look at the premium payable and cost of premium. The premium payable on the bond is your, we've already calculated it on the first part of the part of writing down the information when the call price was given as 1140. So premium per issue would be just what is above the par value, that is 1140 minus the 1000, and then you just do it again, like 3 crores outstanding issue divided by 1000 per issue. That gives you the number of outstanding bonds. The premium paid 140 times that gives you 42 lakh of the premium payable. And we assume again that this is tax deductible. So this is again assumed to be tax deductible. Assumed to be tax deductible. This is again a fallacy. Sometimes the premium which is payable upfront also needs to be amortized. But however, ICA assumes that it is deductible in the year one itself. Okay. And this is the net cost of premium because it is paid at Y0, that is the year 0, no discounting is needed. Okay. Like this was over the 25 years. That's why annuity and UT formula used. Okay. Similar goes for the tax benefit above, and the immediate writing off didn't need any discounting as well. Now we come back to the cost benefit analysis. So we have just covered up all the costs. Now we go for the cost benefit analysis. First is the benefit from refunding. The first benefit is of course the immediate tax reduction that we get, and the annual tax savings from interest cost saved net of the tax reduction. So this is the total savings from the issue of bond. And there is of course a cost of refunding. So what are the cost of refunding? First cost is of course the immediate cost on issue of the new bonds. That is the issue cost of the new bonds, which is just this cost of amortization, or you can just link it to your initial flotation cost. That is of course the upfront cost. You should not forget about it. And there is some loss tax saving and amortization. Again, the fallacy is it is discounted at the post tax cost of it. And there is premium payable at Y0. What premium? Premium on redemption. The redemption premium payable at Y0. Okay. And then there is additional interest of 2 months. And this is not discounted because of course it's an interest. It does not need to be discounted. Additional interest for the 2-month period. You need to pay 14% of coupon rate on the old bonds, 14% on 3 crores for 2 months, out of the 12 months, times the post tax, that is 1 minus 40%, and you do not discount it. Okay, so that's how you get the total cost of refunding. And when you add the two up, or rather deduct the cost from the benefit, you get the net present value of the benefits. And I guess that is about the question. And after tax interest rate of the new bonds, such interest rate represents the current yield, premium, and redemption. I think there is nothing left about the question, but the question is a horrible, conceptually wrong application of discounting mechanism, and there are a lot of assumptions in the question as well. So I thought just make a general video about it, just to cover it up in a quick manner. Catch you up next time.